Hey, what's up, bubs? Welcome to the Basic Concept. Today's topic, how to pick stocks. This topic is something that was asked for by a few of my viewers, so I decided to cover this topic in a little bit more detail than what I generally reply to them in an email. In this video, I will cover the mindset behind picking stocks. I will go over a couple different ways that you can actually use to pick stocks, and then what I personally like to use. Subscribe to the channel and hit the notification bell so you don't miss any future videos. If you do find this information useful, a like is appreciated. I'd like to start off with a few disclaimers. First, this info is for short-term gains only. For example, when I was in the market for an engagement ring for my fiance, I was able to use a short-term strategy to gain approximately 20% more money on the initial budget I had set for the ring. With this, I was able to buy a slightly bigger stone that would have otherwise been out of my affordability and price range. For long-term goals, I would recommend my investing mindset video and my retirement video. I will link them both in the description below. Secondly, this is not financial advice. It's just my opinion and it's for entertainment purpose only. Alright, let's get into it. Let me start with a few different examples of basically the mindset. Say you're in the market for a car. Let's say you want to buy a Tesla. You know it's priced around $45,000 and you are ready to purchase it. However, when you get to the dealership, you see that they have a car on sale for $40,000 instead. $5,000 savings. At this point, you have two options. You can A, buy it right away to be able to lock in that discount, or B, avoid it on a possibility that there might be something wrong with it. Of course, I would pick option A, since at this point I have done all my research and know that this is the car that I want, and originally I was willing to spend $5,000 more than what it's on sale for. So why do you care about this? And why is it in a stocks video? Well, similar to that example, if you do your research for the company first, decide what you want to pay for it, and then look at it buying it, your decision to buy or not will be so much easier. You will be able to recognize the sale and not have to second guess your price of point of entry. That's the short version of the Warren Buffett method of buying companies and their shares. You got to know enough about the company to know if it's on sale or overpriced, whether they'll be around or not, and how they compete and if they are profitable. Let me share another example. Let's say that you are in a market for a car. Again, hypothetically, you find two identical cars, one manual transmission and the other one automatic. You have never driven or understand how the manual transmission works. So even though the manual is cheaper, you would not buy it because you don't understand it and don't know how to use it. If you did buy it, the risk of you damaging this brand new car is way higher than the difference. So the automatic would be the best decision based on risk versus return on your investment. Point of this one was that if you don't understand how something works, don't buy it. Educate yourself first, then decide if it's worth your time, money, and effort. Apply this mindset to purchasing stocks as well. When you buy a stock, you're buying ownership of that company. You shouldn't give your money to a business you don't understand. Let's talk about the media and their influence that they have on the market. Tesla is a really good example for this. Again, I know, I'm sorry. I'm sorry for the repetitive Tesla and car references. They are just way too good. And they fit. Anyways, Tesla stock was trading at around $350 per share. And then Elon Musk, the owner and the CEO, made some Twitter posts that the general media didn't like. Amongst other reasons, the stock fell down to around $180 per share. Now, previously, people were valuing the company at $350 and buying shares. Did it suddenly become less profitable? No. Did it lose its intrinsic value? In my opinion, no, but the media influences heavily in certain stocks. That's because something like 55% of the total market trades are done by retail traders and not professionals. Generally speaking, people are emotional traders. When they see a potential threat, they play cautious, and honestly, I don't blame them. Here's the thing though, with the media, they're almost always too late to report the information. By the time the media tells you about the good news or the bad news, the people who have this knowledge prior will cash out, leaving you with the losses. Just a few days ago, Amazon had their earnings call. Their stock dropped from around $1,750 per share to around $1,650 per share after hours, before the earnings were made public. The point I'm trying to make is that sometimes people and media create hype. Why? Well, the easiest way to sell something is to get buyers excited and emotional about it. That's sales 101. You can actually see this on the sales records as people sold millions of their Amazon shares right before the earnings were made public. And other times you will see a company have bad news and their stock dips only for the company to buy back the shares at a now lower cost. I'm not saying that this is always the case, but how would you know the difference? Basically, don't buy into the hype. Just do your research and decide whether it's worth it or not. Let's talk about the numerical data. Can you and should you use these numbers to decide if the stock is worth buying or not? Let's start with EPS, or earnings per share. I wouldn't even consider really looking at this number honestly. I believe EPS is an arbitrary number. It's based on outstanding common shares, which the company can dilute or absorb to make that number look favorable to their business or their cause. EPS in general is calculated in a period of earnings. So net income minus preferred dividends divided by common shares outstanding at the end of the said period. Typically, the business knows what its profitability looks like before they calculate this, hence getting themselves enough time to adjust the common shares. Not saying that every company does this, but tread carefully. Same goes for PE since it's based on EPS. What about RSI? Can you use that? Well, RSI, or Relative Strength Indicator, is actually very commonly used. It's kind of like a scoring system that rates a stock from 0 to 100. A stock that is closer to 0 is one that is oversold, and one that's close to 100 is one that's overbought. So if you were to pick stocks solely on this, you would want to score closer to 0. Keep in mind that this score does not take things like dividends and other market effects into consideration. You could also take a look at day trading strategy and expand it to like a week trading or even month trading. Day trading basically works with when you're buying into support and then selling into resistance. Or vice versa, you can sell into resistance, like shorting the stock and then buy it back around support. This one's going to be a little bit more hands-on because you're actually looking at the charts and analyzing them daily, weekly, or monthly, depending on how often you want to trade. Me personally, I like using the Dividend Safety Score for the stock. Dividend Safety Score rates the company on the ability to continue paying its dividends. So it does restrict the market to dividend-only stocks, which is about 51% of the market. But dividends to me are a sign of profitability for now and in the future. Dividend safety scores have been able to accurately predict when and if the stock may lose its dividend. And typically when this happens, the stock price will also go down since a lot of the institutions may have that company in their portfolio as an income stock. Another reason I like dividend paying stocks is that they generally perform better when the market is in a decline. Anyways, dividend safety score looks at the dividend payout ratio. If it's too high, it can be a bad sign. If it's constantly growing, that's usually good. It also looks at the cash flow of the company and how they're managing their free cash. It also looks at debt and their interest. If they borrow too much, the interest they pay will dig into the profits and dividends. It looks at dividend yield. Again, a high dividend yield could potentially mean a cutback sooner or later. It also looks at RSI, which is the relative strength indicator as I mentioned earlier. But this score isn't relying solely on this score. Now, based on where you get the dividend safety score from, what website you use, they might look at other factors as well, other metrics. Combine that with the knowledge that you have of the company and the research that you've done on the company, you should be able to craft your own method or style of trading. I wouldn't really recommend copying somebody else's style or looking at like the popular strategies because they work for those people because of their trading styles. Yours is going to be different. You need to create your own and just kind of master it yourself so you're responsible for your own actions. This way, when and if something doesn't work out in your favor, you can learn from that and adapt your style to make it work the next time, instead of simply shifting the blame to somebody else. Let me know what you think of this video in the comment section below. I hope it was useful, educational, and was able to point you in the right direction. The only thing I asked is to like the video, subscribe, and hit the notification bell to help spread this video to more people. Thank you for watching. We'll see you next time.